So it says it's a 5-step, but basically you're trying to figure out how much the new item is based on the new price. All right, so we got these new items priced out. So then we're going to go ahead and we're going to look at when things are earned and recognized. So first thing that happens is on October 30th, we are given the cash. As of October 30th, we haven't recognized anything because I don't know if you remember, but the equipment wasn't delivered to the 31st and the service didn't begin until November. So actually it's all deferred revenue. So cash and deferred revenue on October 30th. I know it's kind of nitpicky, but that's the example they're giving us. Now, on October 31st, the equipment is delivered. So now that the equipment is delivered, we can show an expense of $35, which was the cost of the equipment, right? Then we can earn $80 of revenue, and we're going to have to take the cost inventory out as well. I just switched slides. There we go. Okay. So when we put this in, here's what we got. And if you look, this is exactly what we just did on those last journal entries. The only difference is right here. Instead of cash or accounts receivable in sales, we have deferred revenue because they paid us already. They paid us before we earned it. That's the only difference. So deferred revenue in sales for $80, and that's because we figured out it was worth $80 in the last slide when we took the 40% of the $200, and then we can recognize how much the equipment cost us of $35. Now, as of October 31st, the equipment part of this bundle sale is done. The only thing we have left is the revenue of the service. So now on November 30th, we've had 1 full month of revenue. The revenue we said was going to be $120, which is a nice even number. We've had 1 month, 1/12. You divide that, it's an equal $10 a month, which is nice and simple. So then every month, what we're going to do is do deferred revenue and service revenue. There's no cost of goods sold. There's no inventory because it's just deferred revenue and service revenue. They paid us ahead of time. So every month for 12 months, we're going to take $10 out of deferred revenue and put it into service revenue. That's it. All right. No specific problem on this, but it is something that's more and more common. So you want to make sure you understand, first of all, how to take that 2 items purchased for 1 amount when they originally cost more. You want to make sure you know how to calculate that percentage out and be able to use it going forward. And then the last part is the multi-step income statement. All right, what makes it a multi-step income statement? I don't even have to use my pen here. The book does it for me. Is that the first thing is the gross profit. All right, it goes through and it shows us our gross profit, and then it gives us something called income from operations. This income from operations is used by a lot of companies because this number tells us how much money is Walmart making doing whatever it is Walmart does, which is sells goods, right? Because all the numbers after that, other expenses, income before income taxes, it could also have gains and losses from other items. That has nothing to do with the fact that Walmart has $481 million in sales minus its cost of goods sold, minus its other general expenses. So its income from operation is almost $23 million. That's the key that people are looking for. That and its gross profit, right? You can't do much about your gross profit. That is the biggest thing you can do there is try to get a cheaper supplier. All right, so that's where the focus is there. How can you reduce it? How can you get better? And then we're going to have a ratio, of course. All right, gross profit is gross profit divided by sales, which is sales minus cost of goods sold divided by sales. So sometimes I think when you see it written like this, it's a little confusing. So it's just sales minus cost of goods sold divided by sales, because you're not always given gross profit, right? So sales minus cost of goods sold divided by sales is your gross profit. All right, that is a very important ratio. So then if you look at Walmart's gross profit percentage, I think what's interesting is when you look at this, notice it's gone up by 0.3% every year. If you look at their gross profit, it went up by $500,000 from 15 to 16, and it went up by $2.5 million from 16 to 17. So even though it went up by $2.5 million from 16 to 17, it still only went up by 0.3. And that's because the sales went up by the same amount. So it's weird. Look how much the sales jumped. And here the sales actually went down. Sales went down from 15 to 16. Gross profit percentage still went up. Sales went up drastically here. Gross profit went up, but it still went up by the same amount. So it's a funny number because you're in that number, you're taking into account the cost of goods sold. And typically when sales go up, cost of goods sold goes up. And the way you're going to affect gross profit is when you can get sales to go up more than your cost of goods sold. And that's a tricky thing to do sometimes. Okay, so that